Hello, today we are solving Jan 2024 Unit 2 IAL paper. Question number 3 Part A2 Operating Activities sections from the Statement of Cash Flow in accordance with the International Accounting Standards IAS 7. So you are supposed to prepare the operating activities section of the Statement of Cash Flow in accordance with the international standards. Okay, so that is a requirement. So let's start preparing it. First we had to start from the profit or loss. Okay, which from the point where interest is not subtracted or the tax has not been paid. Okay, so you will start off from that point. So here, but we have the information that the loss after the interest or the profit after the interest for the year ended 31st December is given. So there was a loss, and this was after the interest was paid, but we need to start off from the point. It is usually the cash flow statements are started from the point where tax and interest has not been paid. So we will add back any interest, and because the tax has not been paid still, it's okay. So we will just add back the interest to the loss and start up from the point, from that point. So the loss, okay, before interest and tax. Okay, we will start off from that point. So that is going to be equal to, so the loss before the interest and tax was minus 283,000. Now we have to calculate the interest. So let's calculate the interest. Okay, let's calculate the interest here. There is three type of interest here. One is the bank loan. Okay, one is the bank loan here, and the second we can see there is a debenture loan. Okay, this is a debenture and interest has to be paid, and there was an overdraft for which when interest was charged. So there are three interests that would have been paid here. So let's calculate the interest first for the bank loan. Interest for bank loan. So that is going to be equal to, okay, the bank loan that was there was 2 million. Okay, and then the rate of interest charge was 9%, and this bank loan was paid in 31st May. So we have to pay only from Jan to May interest. So Jan, Feb, March, April, May. So only for 5 months I will be paying the interest. So that is going to be equal to 75,000 pounds. So that is going to be equal to 75,000 pounds. And then we have to calculate the interest paid for debenture. So that is going to be equal to, we can see that the debenture loan was 5 million. So 5 million, okay, into 12% into the interest. Okay, it was issued on June, from June to December. Okay, because these people are closing books in December, from June to December you will have to pay the interest. So June, July, August, September, October, November, December. So you will pay for that for 7 months. So that is going to be equal to 350,000. So 350,000 pounds. Then we have the interest for overdraft. The interest for overdraft we have to calculate. We can see that they had taken an interest amount of 60,000, okay, into the rate of interest was 15%, and they had taken only for 8 months. So this is the interest that needs to be paid. So that is going to be equal to 6,000 pounds. Now let's add up all this interest to the loss and start off from that point. So that is going to be equal to plus 75,000 plus 350 thousand plus 6,000. So that is going to be equal to 148,000. So that is going to be equal to 148,000. Okay, 148,000. We start off from that point. Then we have to adjust the depreciations and other things that had been subtracted in the profit and loss statement. So you will add back any depreciation, okay, depreciation charges. Then there's intangible assets, amortization of intangible assets, okay, you will add, because it was something, okay, it has changed during the year, so you will also add back the amortization amount that would have been subtracted. So add amortization of intangible assets. Okay, and intangible assets are usually the one that cannot be used for monetary value. It will not have any monetary value like a goodwill, skill and that, but still they would have placed a value in the financial statement. So this also you will remove it, and then you will add any loss from sale of from the sale of tangible assets, okay, tangible assets, and then you will less any profit, okay, that was generated from the sale of tangible assets. So this much you will have to adjust the profit. Okay, why are you adjusting? We will want to reach a point where cash generated, it is the actual cash, okay, it is the actual cash before any working capital changes, the actual cash flow, okay, it will represent the actual cash flow before any working capital changes. Okay, we will have to come to that point to get that. So now let's see what is the depreciation. Depreciation we had already calculated. This was the amount that would have been subtracted in the statement and profit and loss. So we will add back that amount here. Okay, then amortization of intangible assets. So here we can see it is 20, it is nothing but 700,000 minus the 100,000, okay, and then plus there was a purchase of 1112,000. So this was the amortization that will be added back. So that is going to be equal to 700,000 minus 100,000, okay, plus 112,000. So 712,000, and then you have, okay, and then you have add loss from the sale of tangible assets. Okay, so let's, what is the loss or the profit from the sale of tangible assets? We can see here on 14th October an equipment cost of this with a carrying value of this much was sold. Okay, so now let's calculate the profit and loss. Profit and loss from sale of tangible, from the sale of equipment. So that's going to be equal to any cost, okay, minus depreciation, it's accumulated depreciation we have to take, accumulated depreciation plus the cash received. Okay, that is going to give you the thing. Okay, now first one we have to calculate what is the accumulated depreciation for this asset. So 315,000 minus 216,000 we had already calculated in the first part. It was 135,000. So now let's replace here. So 351,000, okay, minus of its accumulated depreciation was 135,000, and you got a cash of 191,000. So that is going to be equal to, so they have got a loss of 25,000 because the cost is still greater and they have got a much less value. So this is going to be a loss. Okay, this is a loss. Then we have to calculate the profit and loss from the sale of a property. Profit or loss from sale of property, that is going to be equal to, again we have the cost minus accumulated depreciation plus the cash. This formula we will use. So that is going to be equal to, we have the cost as 2,880,000 minus of, okay, accumulated depreciation was 715,000. So 715,000, okay, and the cash they received was 2,812,000. So that is going to be equal to 2,880,000 minus of 715,000 plus 2,812,000. So that is 3,527, okay, 3,527,000. Now they have got more than the cost, so this is a profit. Okay, profit of how much is 2,880,000. So that is equal to 647. So profit of 647,000. So profit of 647,000. So now we have to adjust these here. So here loss is 25,000 which we have to add back, and the profit we have to subtract, that is 429,000. So that is the cash flow from the before any working capital changes. Okay, that was a cash flow. Now we have to include all the working capital, which is current assets and liabilities. So first one we have the inventory. So let's write here, okay, inventory. Then you have the trade receivables. And then you have the other receivables. And then liabilities, you have the current liabilities, you have trade payables, which comes under the working capital. So trade payables and other payables. Only these two are related to operations, so we are including only these. Now the way this works is, you will find the difference between the opening and the closing and try to understand whether a cash inflow has happened or outflow has happened into the business. First one is the inventory. So the inventory is going to be equal to, okay, so 5,136,000 minus, okay, the closing was 5,320,000. So 5,320,000. So now that value is going to be equal to 184. The difference in the magnitude you have to calculate, and then you have to decide. So you have bought the inventory, there is an increase in inventory, so this is a cash outflow. Okay, so it is a, you will have to subtract less any cash outflows, and okay, less cash outflows and add cash inflows. So here this is a cash, here inventory, okay, inventory increase, this is a cash outflow. Okay, then trade receivables. So trade receivables, here we have seen it has decreased. 309 to 299. This is a cash inflow into the business, and the amount is going to be equal to 10,000. So if it is a cash inflow, you will just add, so 10,000. Then other receivables, okay, other receivables 28,000 and it has increased to 37,000. It was 28,000 and it has now become 37,000. This is like a cash outflow. Okay, trade payables. Trade payables is 3,095,000. Okay, minus 3,114,000. So here there is an increase in trade payable. This is like a cash inflow that has happened into the business. So the difference is around 49,000. So that is going to be equal to, okay, first other receivables will fill. This is around 9,000. Okay, the difference. So 28,000 minus 37,000. Okay, 9,000 was a cash outflow due to the other receivables. Now trade payables has increased. So trade payables has increased means liabilities has increased. So it is like a cash inflow. So the difference is going to be added. So that is going to be equal to 49,000. Okay. Then other payables. So for the other payables, we can see it was 56,000. So 56,000 minus 71,000. This represents a cash inflow. Increase in other payables represents cash inflow. So that I will add into the business. So 15,000. Okay. This is all going to give me cash generated from the, okay, cash flow, okay, cash flow from operations. This is a cash from the operations. This is represents the cash from the operations. So let's calculate that. 4,429,000 minus 184,000 plus 10,000 minus 9,000 plus 49,000 plus 15,000. This was a cash generated from operations. Now we have to pay the interest and tax, and then the remaining net cash that will be left with the cash from the operations. So we have to pay the interest. Any interest is going to be paid from this amount, and any tax is also going to be paid from this amount. Okay. So interest that's paid is 75,000. Okay, so 75,000 plus 350,000 plus 6,000. So that is going to be 431,000. So the interest was 75,000 plus 350,000 plus 6,000. So that is going to be, we have to subtract that amount. So that is 431,000 has to be subtracted, and the tax payable was 401,000. So tax paid was 401,000. So now let's calculate the net cash generated from the operating activities. So that is going to be 310,000 minus 431,000. Okay, minus 401,000, that is 522,000. So negative. So this was the net cash from the operating activities.